Housekeeping, everything. Thanks everyone, and sorry for the delay there. Some tech difficulties where Zoom kept asking me to register, even though I'm a panelist. But we all made it. So a couple of just housekeeping points here is number one, if you're here for credit for the SEMA Investments and Wealth Institute or CFP, please do stay on the whole time, because if we don't, then you can't get the full credit. Is we need to issue a spreadsheet to the board showing the amount of time people stayed on. So please do stay on for the full time. And as far as the Q&A bar, then please ask questions as we go along rather than waiting until the end. I'll keep my eye on that. If it's something we want to jump in with as we go, then we can do that. Or we'll save it to the end. So keep your questions coming as we go along, and we might interrupt if it's something that we're not going to cover later on. But thank you, everyone, for joining us. And I think this should be informational as well as getting credits for everyone here. We are navigating non-equity real estate, exploring mortgage notes as real estate investments. So we'll be digging more into the debt side here as opposed to equity real estate, which is the thing that we see the most. And then also one big thing that we'll be talking about, I know when people hear mortgage notes, some of us still have some PTSD from previously. So we'll be heading that off face on here to actually talk about how this is very different than what we saw back 2007, 2008. Can we just go back to the disclosures for 1 sec? We need to stay on that page for a moment. I will not be reading all this out, otherwise my voice will be burnt out before we get started. But just pause for a moment. The important things here being this is educational. This is not any kind of product or sponsor specific side of things. It's purely educational. So I'll just let you skim through that. And then on to the continuing education. So first of all, CFP. So this is 1 credit. This is 1 hour. So it'll be 50 minutes and then 10 minutes Q&A. So again, please do stay on for the full amount of time to get your credits here. And then the next one is going to be the Investments, Wealth and Institute. So SEMA is the biggest one here, but there are others here. So this is also approved there. So after the presentation, please drop us a line if you want credits, whomever invited you, and we will log those for you. And also it's worth mentioning is there's a number of other accreditations which need non-specific credits. So they don't need to be approved by that board, but needs to be educational. If you have any other letters after your name where you need to collect educational hours, we can give you an email to say that you attended this. And if you use it, you can use it. So let us know if there's any others that help you here. Introduction to myself, Richard Hillson from Hillson Consulting. We believe that alternative investments are misunderstood, underrepresented, and need to form a part of every portfolio. How do we solve that? 1 advisor, 1 client at a time, typically. I was sick of hearing of having the same conversation over and over again a few years ago, where you say alternatives, people's shoulders tense up because they assume that means Bobby Axelrod from Billions or crypto, when in fact a lot of alternative strategies are a lot less volatile than the equity allocations in some 60-40 portfolios. So how do we make alternatives easier to understand, easier to access? How do we connect quality sponsors with their audience? Anything that promotes the cause of alternatives is in my wheelhouse. And now I will hand over to Lauren and Chris to give a brief introduction to CWS and to themselves.
Thanks, Richard. So my name is Lauren. I'm joined here by Chris. We're the founders of CWS, mostly known as Seveney. It's really our brand and what we're known by. Essentially, we are a real estate investment company based in Virginia, and we like to say that we fix and flip mortgage notes. So we are purchasing performing and non-performing mortgages secured by single-family homes throughout the US at a discount, rehabbing the borrower, and then selling it for a profit back onto the market. So today we're going to kind of, like Richard mentioned, dive deep into this asset class, how it looks in this economic environment, and answer any questions and kind of differentiate between how it's different from 2008.
Chris, do you just want to say hello also?
Sure. Hey, everybody. And as Lauren mentioned, we co-founded Seveney to invest in the distressed debt side. We've been in this space for 8 years. And as we get through this, we can talk a little bit more. And again, as Richard mentioned, a lot of people just always think of 2008 to 10, which again, everything has changed since that time. And we'll talk more about that.
Excellent. So let's start from the top. Here is an overview of the mortgage note industry. So let's start with the basics. Is what is mortgage note investing? What's the space? What does this exactly mean?
Yeah, so Chris, you go ahead and take this one, or I'll, you know me, I'll just jump in on every slide.
Yes, you will. So mortgage note investing is essentially buying a mortgage or somebody's debt on their property. And most people don't realize that over 50% of mortgages actually get sold. If you're watching this and you get a letter in the mail that says, hey, send your payments to this new person or this new company, that's because your mortgage had been sold. And when we look at the overall market, there's over $13 trillion in single family residential debt across the US. And that's typically increasing every year. And that equates about 83 million people having a mortgage on their home. And when you look at, the defaulted side of things, which typically averages anywhere from, 2 to 4% of the mortgages out there being in default, that's about $250 billion at any point in time. And today we're kind of on the lower end because of where the economy has been the last few years, but there's still about 1.5 million homes today that are still in default.
So mortgage note investing is, an alternative, and I don't love using that word either, Richard, so we're on the same page there.
Hang on, let me tense my shoulders up at the dress.
We'll say it's a different type of investment strategy, which is secured by physical real estate. So it's essentially, like Chris said, note investors are buying loans from private lenders, banks, credit unions, hedge funds, or whole loan traders. And you're essentially purchasing the notes at a significant discount depending on their status, which I'll get to in a moment. And you're buying the rights to their future payments. So the investor has purchased the borrower's future mortgage payments and the right to repayment according to the terms of the note. And if it's in default, it's secured by that home or that asset, and you can go that foreclosure route, which we'll talk about later. But there's really two types of notes there. Well, there's multiple, but two main categories of notes when it comes to what we're kind of looking at. You have your performing notes, which are, being paid as expected per the terms of their agreement on time every month. And those are typically purchased anywhere from 60 to 90 cents of the outstanding balance, depending on the loan's interest rate. Then you have non-performing. And this is when a borrower is in default. They fail to meet their repayment obligations, they're 90 days or more past due. And typically those, as given that they are default, you get a bigger discount on. So you're looking at anywhere from 40 to 60% of the outstanding loan balance when you purchase those.
And so, I mean, I actually went through this myself. Is I bought a property in December, and in January got that letter to say it's been purchased, and I immediately thought, I best call Lauren and make sure that I'm on top of my mortgage in case she's just bought me out here. But is that essentially performing? Is that it is just some groups will pull these together and sell with?
Yeah, a lot of people who, I remember buying my first home, and literally within less than a month, similar to you, I got a letter in the mail, and this was before I was investing in mortgage notes. And I called our lender and was like, what happened? We're paying on time. What did we do? Why has it been sold? And that was kind of my first experience with notes being sold. And it's pretty standard that, you know, I think the average time a note is sold in its lifetime is about, what is it, like 7 times on average, Chris?
Yeah, if you hold it like, you know, most people typically don't hold their loan for more than about 7 years because you're either selling or refinancing. But if you did hold it for a 30-year loan during that term, yeah, they typically will be sold on average up to about 7 times. And like you
Yeah.
mentioned, Richard, most typically you see it very early on, especially if you used a type of like mortgage broker and it was a non-bank lender. They, you know, typically always will be flipping those loans.
So their model is to get it executed and flip it basically, rather than holding. Is they're almost an intermediary by trade, right?
Yep.
Okay. I really didn't know. Last time we did this presentation, which was, I guess, mid-December,
Yep.
I did not know this. Now I have personal experience. Fortunately, it's on the performing side, but I did not know this. Cool. So let's now go on to the next slide, and we talk about this asset class in the current environment. But again, we said we'd confront the elephant in the room early on here. So I think that for anyone on this call, and certainly for myself, is you say mortgage notes and you probably get even more of a visceral reaction than when you say alternatives, because for people who don't understand it, they'll have PTSD from 2008. They think of subprime packaged mortgage products with lender issues, systemic, back to them. And so I'm sure this is the number one thing you hear in conversations. How often do you get that? How many people actually understand what it really is? And then if you can explain what is different, because again, not all of an asset class should be tainted by something that's happened in the past to a certain percentage.
Yeah, so definitely very different from 2008. One, in just the loans being written, you know, I'm sure many people have seen, oh gosh, I can't think of that movie, but everyone knows, yes, The Big Short. And you're seeing loans written, given to people who had no business having loans of that magnitude. So, you know, it was very much a lender induced. Now we've kind of swung really hard the opposite way, and you need to give up your firstborn child to get a loan. So, you know, there's that big difference to start. And then when it comes to kind of managing notes, you know, back in 2008, people were underwater. They were walking away from their property left and right. There was really no incentive. They could go rent somewhere for significantly cheaper. Whereas today, you're seeing sky high rental rates. There's no availability of homes, and chances are they're highly incentivized to come to the table and kind of negotiate with whoever buys their loan, because whatever they're paying or should be paying, if they're not paying, is probably a better deal than they're going to find anywhere else. So borrowers weren't incentivized in 2008. Now they are highly incentivized. And then, you know, of course, you also have to understand that these aren't, you know, huge CMO buckets of assets. Like, we're looking at, yes, large tapes, which is essentially a way of saying a glorified Excel spreadsheet, but we're able to cherry pick the ones that fit our specific portfolio versus having to buy in a huge tranche. So there's also that difference. Chris, do you have anything to add?
Yeah, just kind of touch upon a little more, like you mentioned, you know, there was a creation of the Consumer Finance Protection Bureau that caused anybody originating a loan to get licensed. And I have a MLO license, which, I mean, you go federal ID, background check, firstborn, you know, very similar. You mentioned, Lauren. And again, in 2008, there was the 80-20 loans where you'd have 80% of a first, 20% of a second, interest only, no income, no job verification loans. Like you said, the movie The Big Short, anybody could get a mortgage because the people who were originating these, same thing, they were just collecting fees. So they were pushing to get people approved and had no liability, where today there's significant liability and licensing. So there's been a lot of cleanup from that standpoint. So the environment is, you know, the opposite of what it was 16 years ago now. Wow.
and I can personally, again, I've gone through it myself recently, was ridiculously difficult to get a mortgage, especially as someone who owns their own business and isn't a W-2 is, yeah, it is a completely different situation. I think that the key thing there is that people do have significant equity. It's not they have nothing to lose here, and so it really does. It changes the picture completely. So, how is that? Is that the number one thing you get? Is when people hear mortgage notes, is they think back to that? Is that the most common pushback you get?
I think just one, people not, that is one of, once they understand what we do, I think then that is like the secondary kind of question. Well, how is this different from 2008? But I think that this asset class in general is kind of unheard of at like people knowing, like you said, that banks sell loans an average of 7 times in 30 years, or that you can buy these loans or work with them. So I think once they get past the, wait, what do you do? It's like, okay, how is this different from 2008?
Yeah. Okay. So let's go on to what motivates sellers. And you've talked about hand selected rather than just buying tranches. And again, the old theory of it's almost the more trash you throw together under the old mindset, that's diversification, right? No, if everything sucks, then the whole bundle sucks, basically. So being able to handpick these rather than just this mass of subprime loans, which was the previous way of doing this, is significant. So perhaps talk us through what motivates the sellers, and then your handpicking these. We'll go more into the diligence side on your side, but what motivates the sellers? How do you find these as well?
So banks typically, like, will get the non-performing loans off their books, primarily because they're not staffed to manage these types of loans. Example, I had to call a bank a few weeks ago to ask a question, and I got pushed through 5 different departments over 3 days, and they couldn't even find the withdrawal from our account. So, banks sometimes are very inefficient, especially on non-performing assets. And if you are bored some weekend and want to go down a rabbit hole, just Google fractional lending and how banks lend, and you'll lose your entire weekend on that whole case study there. So basically, because of that, and also, these high interest rate periods, that we're in today, if a bank has a loan that's at 4%, that's non-performing, and now it's a liability on their books, and they can go lend today to an 800 credit score plus at 7%, what is the bank going to want to do? Of course, they're going to want to sell that loan. They may take a loss on that, but they're okay with that to get that new borrower in the door, because a lot of these loans will sit on their books for months or even years. The average delinquency that we typically see on loans is, several years. So it's not after 30 days, someone comes knocking on your door and, they're going to come, evict you. And when these do get sold and brought down to other tranches, to larger hedge funds or ourselves, lenders on the secondary market also are constantly looking to, rebalance their portfolio. Certain funds may be closing. For example, we had a loan as part of a pool of assets that we bought, where we cherry picked, but they said, hey, you got to take at least 10. There's one in Montana. And, we didn't have any other assets in that state. So we turned around and sold it. Perfectly fine asset, but it's constantly buying and selling on the secondary markets. And also other reasons, such as liquidity, that you may see, funds look to liquidate these assets. We have seen people sell assets because they're looking for liquidity to go buy other types of assets. So, Lauren, anything else you want to mention about?
No, you kind of hit on all the points. I always just like to say banks are really good at creating debt, not good at managing it. So they stay in their lane. They're looking to be, making money, not losing money. And so as they're not staffed, like Chris mentioned, it might take anywhere from 18 to 24 months for them to foreclose. And that's just to foreclose. And you have to wait on the court to send the funds. Personal experience, Georgia has a super quick, it's super quick with their foreclosure process. When I first entered this space on my own, I went through that process and it was 4 months. And I was like, wow, everyone's right. Georgia's the place to be. It took me 2 years to get, or another full year to get payment from the bank. Just the process was slow. So, you know, when you think of that, and I was, you know, on top of it, emailing them all the time, like waiting to get these funds. When you think of a bank who's not staffed for this, you know, for them, it makes more sense to sell it at a loss and quickly rewrite new paper, like Chris said, at a higher interest rate. So,
And banks don't want the property. You know, if they take it
Yeah.
back, then they have to
yeah.
have somebody manage a real estate owned vacant property, and everyone's seen on the news what's going on with squatters in certain parts of the country and stuff. Like, nobody wants to deal with that.
Yeah. And how do you find these? Is we know why the seller's motivated now, but how do you find these portfolios?
Through relationships that we've had, and the servicing companies, who are the companies that collect the payments on our behalf, because there's certain licensing that goes to be part of a servicing arm. Like Lauren mentioned, whole loan traders, which are companies that also do like M&A trades. The banks don't know who to sell these things to, so the banks will go to a whole loan trader and say, hey, I have a portfolio that we want to sell. Same thing, Fannie Mae just put out a $250 million portfolio last week. Fannie Mae doesn't put it out there. They go to a whole loan trader and say, hey, liquidate this for us. And they wanted, then the whole loan trader will then put it out and sell it. And the buyer's the one that will pay a small commission or a fee. So for a bank that's looking to sell these things, it costs them no money to have a third party liquidate that to them. So think about if you're selling your house and you didn't have to pay any realtor fees. Well, of course you'd get a realtor if you weren't paying any realtor fees to sell your house and the buyer was paying all that fee.
Yep. Okay. So let's move on to what causes distressed debt. And after we've gone through some of these causes, we'll go with the definition of distressed as well.
Yeah. So I think this is probably the most common question. Is, well, obviously if they're not paying, then you're going to want to take the property back. They're never going to be back on track. Why would you take on distressed debt? And I think really people don't just fall behind on their mortgage, wake up one day and say, I'm not going to pay my mortgage anymore. Really, these are the kind of 4 areas. You have job loss, health, divorce, or death. Those are the 4 reasons that cause people or families to fall behind on their mortgage. So, in our portfolio, 90% of our portfolio falls into one of these. It's very rare that we're, going through the foreclosure process with people all the way to the end, because typically people want to stay in their home. There is an emotional attachment to wanting to stay in their home, or you would imagine that most people would probably sell because they have a ton of equity in their home. But it really is, one of these 4 reasons that causes people to get behind. And then I'll let you kind of tee into distressed debt.
Yeah. So that's the first thing I think of. Is I think a lot of people think of distressed as almost kind of like a dirty word. Is that I get, let's take real estate rather than mortgage notes. Is the first thing I think would come to most people's minds if you say I'm buying a distressed property is they think a rundown property in a less desirable neighborhood that's going to need a load of capital to it. Whereas sometimes it's economically distressed. Is to your point here, maybe it is a husband and wife who one of them has died and they want to get out and sell at 20% under market because they want a quick sale. That would also be distressed. And yet it's not the distressed we think of, which is needing a huge amount of renovation and capital intensive. So I think that whereas most people would think distressed is not something that's attractive to them and needs loads of effort and capital, is opportunistic the word? Because I think that entrepreneurs and serious investors would think distressed and opportunistic are probably interchangeable, and they love distressed assets because it's a chance to pick something up under market value.
Yeah, I think you kind of nailed it when you you alluded to, the difference is the property is not distressed. It may be, we do go and view the properties to make sure they're not distressed, but it's really, when we talk about distressed debt, we're talking about the borrower. So the borrower is in some sort of distressed situation, or that has caused them to fall behind on their mortgage. So we see this as super opportunistic because, one, we're buying these at a discount, and unlike banks, like banks are notoriously inflexible. So we're filling that gap. We're just meeting them where they are and restructuring these loans and creating kind of a win-win. They're staying in their home, they're getting back on track, they're getting reperforming, we're getting paid while they're getting reperforming, and then we're making a profit when we sell back onto the secondary market. So opportunity is in that the borrower is distressed, not the property, but they're also incentivized to come to the table, especially like I mentioned in this economic climate. So there definitely is a lot of opportunity in this specific asset class.
I think that's really important as well. Is everything is so algorithmic in life. Is gone are the days. I remember my dad was a business owner, and he'd play golf with the bank manager if he needed to extend his overdraft for 60 days or something. And it was done based on personal relationships and personal circumstances. Nowadays, if a computer program categorizes something as not on the fairway, nothing anyone can do. There's no discretion. So yeah, I agree with that. Is banks are notoriously inflexible, and if someone has lost their job but has literally just got another one which starts in 90 days time, even if they've got an offer letter and they're going to earn 4 times more than they would in the previous one, if it doesn't fit within the algorithmic kind of analysis, it doesn't matter. So I think that I agree with you. I think that's an opportunity there. It's actually people who genuinely want to come to the table and figure out their circumstances, and the compartmentalized approach of financial institutions is just notoriously inflexible.
Yeah, I can give an example, and I give this example a lot, so maybe people listening have heard it, but it stuck out to me. And it's kind of an easy one to wrap your head around. So we had a borrower who came into some health issues and ended up not being able to pay. By the time they went back to the bank, they were so far in arrears, but they were still able to get, pay their monthly at that point. The bank, being as they are inflexible, you can make those payments, but we're going to apply them to your past due, your late fees. So at that point, there's really no incentive for a borrower. They're just perpetually going to be behind. Whereas we get this loan, we're able to say, okay, do a trial payment plan, make 6 consecutive payments, your normal monthly payments, and then we will work on either quarterly payments. We can extend the term and wrap your arrears into the end. We can get creative. And that's kind of, I know, one thing Chris and I really love about this asset class is the creativity that goes with it.
Yeah.
And also just add, like the decision-making process where we can make decisions very quickly, and banks, they have a lot of departments, processes, and red tape. And we've seen, for example, where there's a borrower who was trying to work with the bank, but the bank could only accept paperwork. It was only valid for 90 days. And the borrower would give them the paperwork, but by the time it made its way through all the departments of the bank, the 90 days had passed. So it got to the end and it got rejected every time because it was past 90 days. And, the borrower was just going in a circle because they were trying to figure something out. And the bank was kind of tripping over themselves. And we bought the loan, and, the borrower was like, hey, can we, we're like, hey, if you want to still do this plan that you were proposing, let's do it. And within 2 weeks, we had a down payment, and we're working with the borrower.
I've got smoke coming out my ears in frustration even hearing that, and it's not even me in that situation. It's crazy, and that's how people get into real trouble with any kind of borrowing. Is penalties and missed payments start to accrue, and you are just always back, kind of fighting that lag there of penalties and missed whatever, rather than, like you said, tagging that onto the end so someone can get current again. So yeah, That's really good digging into that, and that distress definition I think is really important. Let's talk a bit more now about debt versus equity and we're talking not just mortgage notes, but kind of in real estate in general, I believe, is that a couple of years ago, everyone was looking at equity in real estate, and multifamily was the darling that we would see 60% of things presenting at the conferences were probably multifamily equity. And now people are looking at real estate, but what other return profiles and risk profiles? Let's actually look at some debt in real estate. I mean, you didn't see many debt in real estate as kind of a packaged product a couple of years ago. So let's talk about this debt and equity profile in your space, and then I guess in the wider real estate investment market.
Yeah, and it's very unique space because there's a lot of opportunity in both asset classes, or being in the debt side of things or on the equity side of things. And some of the debt risk you have to look at is understanding whether it is secured or unsecured, because anything that is unsecured does have that higher risk. And if it's secured, making sure, again, what is it tied to? Is it tied to a single asset, to a portfolio? On the equity side of things, you are typically on that secure side. And anytime anything is secured, that typically does reduce that risk profile, and also looks at spreading that risk against a full, portfolio of assets, and just understanding, some of that capital stack of where things fall into play within that asset class. Like you mentioned, multifamily side of things, there's sometimes, a bank is usually, a debt sponsor who's locked into that position. But also some people can come back over the top and be in a separate, like a mezzanine debt position, which is unsecured, or, in between some of that pref. Lauren, anything you want to add?
No, I think you covered it.
Okay. And so let's talk about this current environment that we're in, where everything's very different than it was a couple of years ago. And a question, it was a kind of tongue-in-cheek question, but it's something that I thought was kind of worth mentioning, is the interest rate side of things with your what you're acquiring is, and let's make clear to everyone we're speaking about, and you'll probably articulate this better than I'm about to, but this is not that you're acquiring something and then you've got a magic wand where you can get a 1% better interest rate than anyone else. You are getting the same interest rate situation. You're getting the same yield as anyone else. It's just simply that when you are buying that at a discount, the numbers are so much more compelling because of the 20 to 60% discount. Is that right?
Yeah, so we like to say we're interest rate agnostic. I mean, because we're bidding based off a specific return. When we're restructuring, we're not touching interest rate. So it's not like the borrower comes to us and we, like you said, have a magic wand and we can get them a better interest rate and everything's better. We're really it's more of focusing on, can they make their monthly, and getting them restructuring the arrears past due. So not only on the acquisition side are we focusing on, okay, what percentage discount do we need to get the specific yield we're looking for on this asset? But then once we acquire the loan, it's focusing on restructuring the arrears and getting them paying again. So
one thing I'll just add is, we're not originating the loans. Like Richard, you just got a loan in December that, let's say, was at 5%, and all of a sudden, if loans shoot up to 8% next month, it's not like we just originated at 5% and kind of like bonds where, they sell, it's a different discount. For us, like Lauren said, we just target a yield. So if we're targeting call it a 10% yield, and the paper was originated, say, at 5%, that's roughly, okay, maybe it's a 50% discount because we're trying to target that specific return. So by not originating loans, we're not we're getting stuck with that rate. We're not we're agnostic to the interest rates as well.
Yeah. So the return profile is based on the discount that you acquired it at, not at tweaking anything else.
Correct.
That makes sense. Okay. Excuse me. Let's have a look at the I guess the opportunity in the market. So why now? There's a lot going on. Inflation and interest rates are probably the major topic on most people's lips. So talk to us about why there's somewhat of a perfect storm of an opportunity at the moment.
So we see foreclosures are on the rise. They're slowly starting, post-COVID, and a lot of state programs are winding down. There's stats out there that anywhere from 50 to 70% of people are living paycheck to paycheck. And if I ask anyone I know and say, oh, inflation's only roughly 3%, I think everyone kind of will look at you funny, because every time I go to a grocery store, I keep seeing prices either going up or the quantity of what you're getting going down. So things are getting more expensive with the inflation and the people living paycheck to paycheck. And we're starting to also see, I think, a little bit of slowdown in jobs, even though reports coming out are, jobs are increasing. We're still seeing a lot of white collar, high paying jobs starting to slow down. And all of this is putting pressure on homeowners. Interest rates are still, historically average where they're at today. I think everyone probably is of the opinion the Fed isn't going to be dropping rates, in that next meeting. And then mortgage rates, which are really based off the 10-year Treasury, that has gone up because other countries like China are going through a slowdown. So they're not buying as much of our debt. So that's also keeping interest rates up. So there's just so much macroeconomic issues that go on that can impact things. But breaking it down very simply, that things seem to be slowing down and getting more expensive, which then impacts people's ability to pay all their bills, including the mortgage. And that provides more opportunity. Lauren, you want to add anything?
No, I think you covered all the areas I would.
Okay, so then let's look at why a mortgage note fund, given that context in the current environment.
Go ahead, Lauren.
Oh, okay. So essentially, when people look into this asset class, a lot of people will maybe view it as super passive. I know I did when I first got into it. While it's, I'd say, passive adjacent, meaning, you're not doing the same kind of active involvement as you would if it was a vacation rental. Most people who are looking to be truly passive will want to invest in more of a fund structure. So where someone else is managing the assets for you and your clients or investors are, collecting those dividends, not having to be actively involved in any way. It's collateralized by, in our case, single family homes. So unlike stocks and bonds, which are, secured by very little collateral and have such high volatility, the note space is much less volatile and secured by physical real estate. So example, in the case that a borrower decides, hey, I'm never making another payment again, you do have the right to take back the property. Now, does that happen in our case? Very, very rarely. But again, it's that security and knowing that there is, another exit strategy should nothing else work. Speaking kind of along those exit strategies, I mentioned earlier that the ability to be super creative is something that Chris and I both love about this asset class. So there is in the note space that versatility. So there's not one kind of recipe that works for every single borrower, and having the ability to work with borrowers in different ways allows us to, really increase our returns. And then investing in a fund, you're really mitigating that risk by investing in a portfolio and not being tied to the outcome of a single asset, rather the performance of the portfolio as a whole. So definitely that would be, for people who are looking for more of that passive play, I guess you could say, not necessarily wanting to be active. I don't love the term mailbox money. but you know, I'll use that term here, who are looking for more of that mailbox money investment rather than something more active that they have to be involved with.
Okay.
I'll just
Um,
add quickly, just back to like a little more, the correlation factor. Now, it's really has no correlation to stock market. Also, even sometimes to real estate prices, because some of a lot of loans we acquire are 10, 15 plus years old. And those loans, you know, have such appreciation over the last 10 or 15 years that slight dips within the real estate market really don't have much of an impact on those.
Yeah.
So correlation for people looking for diversification is another major factor.
Yep. Okay. We've got about 10 minutes since we started a bit late, 10 minutes, and then we'll do Q&A. So we might want to move a little bit quicker through these. I think
Okay.
we've got maybe 9 slides or so, but there'll be a Q&A or so. So let's move a little bit quicker through these last few. We've actually covered quite a few of these a bit already. We've touched on earlier in the presentation, but talk us through this like the timeline that
Yeah. So typically this is kind of when I mentioned at the beginning, the fix and flip process. This is really what I'm speaking about. So essentially the first step is you're buying those loans on single family homes at a discount to unpaid balance. And therefore you kind of have a few exit strategies from there. But the main one is being the top one, the negotiating a payment schedule with the borrower, generating cash flow from those payments. And then the flip being selling it as a performing loan. The borrower either sells or refinances the loan. And that's probably, I'd say about 90%, 90+% of our 90 to 95% of our portfolio these days. And then taking ownership of the home. So the borrower decides not to work with you. You can go the foreclosure route, take back the property. In these days, it usually will get sold at auction because that is not what we do or specialize in. If you do take back the property, you can sell the home. So it's, again, there's that fix, buying it in a distressed situation, increasing it in value of the note, and then selling it for a profit. So, yeah.
And what percentage does it end up with you actually having to
Take the property?
Under 10.
Yeah.
Okay. Well,
Very rare.
That's pretty good, because yes, it takes some work, but taking something that is non-performing for one of those reasons we've talked about, restructuring and having some conversations and getting it into performing and then selling it on, that's a pretty nice arbitrage. You know, this is your business, but that's a pretty nice arbitrage if you're not having to actually liquidate 50% of each portfolio and going through the mess of auctions and foreclosures and stuff like that.
Yeah, exactly.
Cool. Okay. And then this is important, is you can talk more about what you guys do rather than the industry, because this is your secret sauce here. But how do you actually mitigate some of the risk here so that, and it seems like you're doing a good job of it based on the low percentage of ones that actually go to the foreclosure side of things. But talk us through this.
Yeah, so the bidding and acquisition process is kind of like buying a home. You know, you're looking at a tape or a list of loans where you're able to put an indicative bid down, you know, just like you would if you're going to buy a home, you'd put in an offer. We base that off of our buy box, high level buy box, you know, value of the property, return we're looking for. Is it in a specific legal status right now? The seller then says yes, no, or they'll counter. Once we enter into an agreement, we have a due diligence period. So it's not like we just give them that bid, they accept, and there you go, the loans are ours. Really, that due diligence period of anywhere from say 4 to 6 weeks is where we do a deep dive on every single asset. So we're looking at the property, making sure, getting eyes on it to make sure it's, you know, in fact, still standing and in good condition and is valued at what the, you know, seller has on their sheet. We're looking at the borrower. We're making sure, you know, looking at, you know, what situation caused them to get in distress. If it's a distressed asset, we're running title, making sure it's a, you know, first position lien, making sure that there's, you know, no outstanding taxes. So a lot of the heavy lifting comes in that due diligence period. And that's where we have not only an in-house team, but also a ton of vendor relationships to help us streamline that process and make a decision moving forward. So that's really at a high level. I'm trying to move quickly through this for
Yeah.
the sake of time, because I could spend an hour just on risk mitigation and due diligence.
And we can, if we don't get many questions, we can come back to that in a bit
Yeah.
more. But if considering we've got 5 minutes before questions, if people have any questions at the moment, tap them in, and then we'll know how to use that last 10 minutes based on how many questions we've got. I think moving on to the next here is this is kind of a kind of a hypothetical example here.
Mm-hmm.
So this is an example where, it's a $250,000 property that has a $75,000 loan balance. Like I mentioned earlier, could be 15 years old and they've paid it down and the property appreciated. We might buy that at 70, at a discount of, call it, 70 cents on the dollar. That then purchases it at $45,000. So you can see that you still have a $250,000 asset. The loan balance is about still very low LTV. And then when you look at your investment to value, that's, even brings it down further. So, and that's kind of one of our, I'll call it secret sauces that we like to look at are loans like this, because borrowers, when they have this much equity in the property, there's that sweat equity, but the emotional equity, because they've been in that home for a long time. So it's a borrower that does want to try and work something out.
Yep.
Yeah, that's significant. That this is not. There's significant equity already been, and they've been paying off this for a number of years. So you'd be surprised if they didn't want to figure something out one way or the other. And numbers look really good from a risk mitigation point of view, in terms of it would need to be one serious fire sale for you not to be able to recoup the investment on your side there. Let's look at some case studies here. As we've talked a lot hypothetically about the industry and the situations, but let's go through some actual case studies of properties that you've been involved with.
Yeah, here's one that was up in Maine where the balance, you can see the statistics here. And the story with this one was the borrower, husband had passed away and the house was too big for the borrower. So they were in the process of renovating it. The renovations cost a little more than they thought it was going to, and they put it on the market. But during that time, they fell behind on the mortgage. And they were kind of the mindset, well, we're selling it anyways, and we got plenty of equity. So once it sells, we'll just catch up on the mortgage. And in this instance, the seller didn't want to, seller of the loan didn't want to wait for them. So we acquired the loan, and within the span of, 8 months, ended up getting paid off. So this was a situation where the seller of the loan basically just, was liquidating their portfolio, and it was a great opportunity to purchase. You can, again, a low balance loan with significant equity. Lauren?
Yep. Trying to think of.
Here's one that is more, I'd say, of, what we'll say the bread and butter, where, again, low balance compared to the value. And this loan wasn't performing. It was about a year ago. And a lot of times when people stop paying, they also stop opening their mail, because it's one of those things where I can't pay it, so it goes in the trash. So one of the first things we usually do is have a letter get sent from an attorney. So when someone says law offices of something, usually somebody opens that mail to see what it is. And this one ended up getting the borrower to come to the table and had the borrower, start making payments. And, as of this payment last year, they had made, close to $6,000 of payments, which was already 12% of our acquisition price. And this loan, actually, the borrower is still continuing, to pay to this day. And this is a loan that we're in the process now of getting ready to go back and sell this back on the market now as a reperforming loan. And like you said, get that bump.
And what would you guess your actual arbitrage there would be in terms of a percentage return, doing the work for 12 months to get it back to performing and then flipping it as a performing?
Yep. So, this one I think was bought right around 70 cents on the dollar, and taking out what we've collected in payments, and a lot of the payments are, still primarily interest, so their balance doesn't really go down significantly. This will sell, if it was bought at 70, it's probably going to sell somewhere in the mid 80s. So a 20% bump. That one. So this is another case study again where we got a borrower to reperform, and in this instance, we help the borrower get state assistance. So a lot of states from COVID and even post-COVID, even through this past December, actually, we worked with a borrower. You can get state assistance for the borrowers where the state will step in and give money to reinstate that loan. And in this instance, we assisted with the state and the borrower to get the funds from the state, which at the time we got essentially the amount of funds from the state that we paid for the loan, or a little bit more than the loan. And there was still a balance left on the loan that after we did that, we collected a few more payments and again, turned around and sold that back on the secondary market. And this one, I think, sold to an investor who had a self-directed IRA that had, a little bit of money in there, and they wanted to test out note investing. So that's what they use the funds for.
Okay. Well, we're just coming to a close here. We'll go on. We'll go on till 5 past the hour if we have questions. If not, we'll stop bang on the hour. Please use the Q&A bar now if you've got anything coming in. And if not, then maybe Lauren will go back a bit more to the diligence side of things, where we skipped over that pretty quickly, and we've probably got another 4 or 5 minutes on that. So if nothing comes in on the Q&A, then that, or if there's anything else you want to go back to specifically that we rushed through a little bit. But I think that's pretty important to talk about the risk mitigation side as much as we can.
Yeah, I'm sorry if I don't see any questions, which I don't, then I will go back to that slide. And just talk about the due diligence a bit more. Sorry, I ended this preemptively, so bear with me for a second. So, and Richard, feel free to pause or jump in if someone does have a question. I'm on the one screen, so I cannot see. I think the important part really that I kind of skimmed over was the borrower. When we evaluate the property, we're evaluating obviously the asset, its value, verifying that. The whole due diligence process is really trust the data you were given by the seller, but verify. And so you're not only looking at the property, making sure the value is there because, like Chris said, one of our things is really the equity coverage. It's really important to us and something we focus on, but also the borrower. And not just the situation, which is a third bullet point in of its own, but the borrower's ability to repay in as like, are they a serial bankruptcy filer? Is it owner occupied? Is this a vacation rental of theirs? What is the borrower's situation now? And then what caused them to get behind? And we can see typically from prior servicing notes, what caused the borrower to stop paying. So if we can ascertain that they're not a serial bankruptcy filer, they don't have any criminal record, and then we look at the servicing notes and see that they lost their job, well, that gives us a good idea that this borrower is probably going to be someone that we will be able to work something out with. So a lot of it comes down to this kind of, obviously the legal aspect of it, making sure that the lien is in order, that no taxes are due, and legally everything's, clean, but also what's the borrower's ability to repay and what is the value of the property. And I think, we do a lot of research on the borrower and the situation more so than just the property. And I think that's something that not a lot of people in our asset class focus on. So, yeah.
Yeah, the record for bankruptcies we've seen is 8. And we also check things like criminal history, criminal record, kind of get an understanding. And, we've seen one borrower that, again, we passed on the 8 bankruptcies. We've also seen one where it was a 17-page rap sheet. So that was pretty impressive. We passed on that as well. So like Lauren said, it's not just about the property and the title, it's understanding, you know, is this a borrower who we think we can work with? And that's where I think, you know, goes back to the low percentage of foreclosures, is because a lot of these people do communicate with the servicer. They do try and work something out. They just had some temporary hardship that they're trying to overcome. And sometimes when you're working with some of these lenders, it's like talking to a wall.
Yeah.
Right.
So I think that the focus on that, but also the fact that we have a in-house team allows us to do that. So like, we don't outsource our asset management, our acquisition, or any of that. And it allows us to really be that hands-on with the borrowers and do that deep dive into their history versus kind of outsourcing everything and just getting big picture footnotes back.
Well, that's your sweat equity, isn't it? Is you buy something that needs some work.
Yep.
You buy the stuff that your
Yeah.
work actually yields something, and then get it into the performing category and flip it. It's a compelling strategy. Okay, we had no other questions come in there, so we can wrap up. So thanks everyone for joining us today. Remember, ping whomever invited you for your CE credits if you need that. Any questions for myself or from Lauren and Chris, then please get in touch. Happy to dig in further on anything. Lauren and Chris, always a pleasure to present with you. Thanks. And looking forward to doing another one of these in a few months' time. And hopefully there'll be no developments on my side with any mortgage between this one and the next one.
Thank you so much, Richard. Yeah, if anyone has questions, feel free to email us. Have a good one. Bye, guys.
Bye.